Good afternoon. I'm here in our Singapore office where I was spending 2 weeks holiday with my family. Couple of messages what happened in the last 2 days. First, the single most crowded trade in global markets over the last 2 years has been short yen because of the zero interest rate policy and long Nikkei dollar hedged and Nasdaq stocks. This was predicated on a dovish BOJ and an hawkish Fed that alone on 5 years would have read the differential in interest rate at almost 25%. So basically people were funding in yen and then going long dollar assets, Nikkei in dollar, the index, and Nasdaq itself. As soon as the yen hit 160 and suddenly the BOJ hiked only 15 basis points, 15 bips with an hawkish message was enough to basically send a reversal in yen from 160 to about 142. So the yen appreciated by more than 16% for just 15 basis points. That tells you how extreme positioning was, totally outside fundamental value. We made this very clear to investor, and hence at around 160 we said there was massive value because of the structural value in yen at around 160. As the funding leg basically appreciated from 160 to 142, all these fast trader pods had to sell. What did they sell? They all sold at once what they had long, which was Nikkei in dollar and Nasdaq. Part of this reversal has been cleaned up. Today the yen short positioning is more neutral. I think it still offers real fundamental value here as a currency in terms of diversification, in particular vis-a-vis the dollar. So on a global basis, we think that, particularly in Asia, India is likely overvalued and too many investors are long India. No one owns China. It's one of the cheapest markets I've ever seen, including the currency. So I think there is more value in China than elsewhere. Secondly, in Europe, very few global investors are long Europe, let alone mid-caps. I think there is lots of value across Europe, and there is a likely realignment of the war post-US election. No matter who's going to win the US, I think the war is going to de-escalate between Ukraine and Russia. The same is going to happen in the Middle East. It's going to be a de-escalation post-US election because there's going to be clarity and certainty on who's going to run the show for the next 5 years. In the US, we have real economy holding up, even though slowing, and we have a tech economy which remains in bubble terms because everyone is investing, but revenue are not there short term, and particularly for some of all these investments, and we need to see. So there we advocate caution, and overall we see financials are still great value, particularly in Europe, where dividend yield plus share buyback, so all in free cash flow yen, are between 10 and 12, 13% for the major company. Credit in financials still yields 7 to 8% in dollar, super attractive, in particularly with global interest rates, where the next move is likely to be down rather than up. And in this, a time where valuations are high, the position is extreme, and the global economy is slightly slowing, not entering a recession, but clearly going through a bit of a soft patch.